Where I think we are, and I'm going to talk general economic first and then the metals. Economically, we're very end stage here in this bull market. Traditionally, we have financial bull markets last about 4 to 10 years, and then we have a recession, or in every 80-ish years there tends to be a big event like a depression, or 80-ish years from the last depression. So I think we're in the super cycle stage of where we're setting up for the next big crash, and that's what I wrote my book about, Drop Shadow: The Truth About the Economy, about 12 years ago. I think all of that has led people to wake up to the issues with the financial system. So you saw it on Wall Street bets, and you saw people starting to take more chances. I think people are realizing they need to find alternative methods to seek value. And so some people were doing that by shorting, penny stocks, and then they got into, shorting or going long some of these micro caps in order to bid up the price. And then that kind of spilled over into silver, because there were a lot of us have been following silver for a very long time and saying, this is undervalued, this is undervalued, this is undervalued. We're having shortages. The miners can only put out 800 to 900 million ounces a year. Look at this demand exploding. Over 1 billion ounces. The Silver Institute thinks this year we'll have over 1 billion ounces needed in the economy. There's not a lot of above ground silver because of the way that it's distributed so many millions and billions of times in these products, little amounts. So it's not as easy to recover as gold, and only a portion of it's recovered as scrap. And so people were looking at, what about silver? What if we squeeze silver? And so there was a movement, I think, to go into SLV, which is a derivative product really intended for generalist investors to get price exposure to silver. And then it kind of went over into PSLV, which is Sprott's, which is completely different than SLV. It's more tied directly to physical silver itself, and it's a closed-end fund, so it's not really, you can't really build it into a bubble. And so a lot of that occurred. And then we saw the shortages at the end of January, beginning of February, started to see shortages. Miles Franklin was reporting them. SD Bullion, all the big bullion dealers here in the States, were reporting that. And so what we saw was a movement. And what I saw was a movement into silver. And it wasn't just us old-timer gold and silver bugs. It was a younger generation. It was a millennials who I've credited for waking up, seeing the situation they're going to be in as a generation, because this is their prime earning time. A lot of them are getting in their 30s. This is supposed to be the best time of their lives, and they're seeing all the financial issues. So they're saying, I need to prepare for this. And so they went into silver. But they started off with SLV, and then we got the word out that, hey, SLV doesn't really allow you to redeem for the silver. Maybe there are other options. And so then it shifted over into all forms of physical. And I think this movement is building. We're not seeing the price explosion, but that doesn't surprise me. That has to do with the futures market, and we can talk about that if you want. There are controls in place around how the futures trade, and it's the paper futures that determine the silver and gold price, not the physical trade. But the physical demand has just exploded, and it's moved from those early derivative products that really are meant for generalist investors that don't have real exposure to silver into the physical. And that's why I think we're seeing the shortages. There have been reports from some people saying that the 1,000-ounce bars that you would get on the COMEX, or that you can get through, a limited set of retailers, if you have about $30,000 to invest in one of those, are starting to see shortages. Now, there are some out there, but there aren't a lot. And you have to remember, silver market is very tiny. So any amount of generalist investor movement into silver is going to absorb that very, very quickly. And you're going to see, the big price uptick that we've all been waiting for. So what I see is a lot of this bubbling below the surface, but there are more people interested in precious metals, and specifically silver, than I've seen in my 12 years following it, even after the last financial crisis. And that's a very positive thing, because it's a movement. It's not a short-term deal where people are speculating like Wall Street bets and GameStop and AMC. It's more of a movement thing. It's got some legs behind it, and we're seeing that develop over time here, and it's actually really encouraging. And this is where it gets really complicated, because the spot price that you'll pay at a physical dealer, when you pay that at a physical dealer, you think it's local supply and demand, or it's some market that has to do with physical, and it's not really. The way, in order for commodities to have some level of price stability, is that we have to have this futures market where, let's say, for example, you're producing corn, and you're a farmer, and you've got to plan how much can you plant, how much can you spend on fertilizer, how much can you lease equipment, so that you can get your corn to market. And there may be a 5 to 6 month planning process, and actually planting it, getting it on the ground and putting it in a silo, processing it, and then taking it to market. So over that 5 to 6 months, you have price exposure, and that price exposure could bankrupt, smaller farmers because they work on sort of a yearly sort of situation with being able to finance their business. So the futures markets came about for legitimate hedging. Legitimate hedging is when you're a producer or a merchant who's going to be using it and you have price exposure and you have to plan that risk out. So the futures markets were started with good intent. But what happened with the futures market is now there's much more speculative activity in that market than there is actual physical trading. So if you look at the precious metals specifically, gold and silver are delivering much fewer contracts on a daily basis, the physical, than what we're seeing in the futures trading. Futures trading is hundreds or thousands of times bigger. And that's a speculative activity because those aren't all legitimate hedges, because you have these big bullion banks getting in it and you have the hedge funds getting in it. That's all for price speculation. So essentially what happens is the price gets determined now by that futures trade and sort of in conjunction with the London markets. The London markets are these over-the-counter unallocated markets. Those two together kind of determine the spot price. So what I do a lot on my channel is I go into the CME Group's website and I look at the price activity and I tell you why the price is moving based upon how the futures are being traded. So to shorten that, to summarize it, the futures trading determines spot price. And that paper trading has a different set of rules than what you see in the physical. And it's different players. They're not there necessarily to take possession of the physical. They're there to speculate on the price. And what we see in addition to that, and I'll add one more aspect of that, there are 4 and 8 traders who have concentrated positions shorting the precious metals, both gold and silver. And those tend to be the bullion banks mostly, but they also could be some other large financial entities. And when you have that large of a concentrated position shorting a paper market, which has nothing to do with the physical, they're called naked shorts because those contracts don't require physical to back them. Whenever you have that much naked shorting, it keeps the price within a certain trading range. And I would argue it actually disrupts the market from doing what it's supposed to be doing, which is overall price stability, because where, let's say, silver should be going up higher in price due to shortages would actually help the producers of it to produce more. The biggest cure for high prices is high prices, and the biggest cure for low prices is low prices, as Rick Rule says. And that's true. You have to let the market determine that. When prices rise, we can produce more. When prices fall, we produce less. The futures market don't really allow that mechanism to work. And so that's the issue that we're having. And that's why you have this massive shortage in physical silver, but the price just isn't taking off. And I also further think that some of the people that are shorting silver may be taking physical delivery for their own means, because when you have that much control of a market and you can get physical cheap, why not do it? It gives you an advantage.